Property and Casualty Insurance Exam Cheat Sheet. Welcome to the quiz. What is the primary exposure covered by a directors and officers (D&O) liability policy? Is it A, wrongful acts in their capacity as managers of a corporation, such as breach of duty or misleading statements? Or B, physical injuries occurring on corporate property? C, employee theft? Or D, damage to corporate property? The answer is A. Directors and officers can face lawsuits from shareholders, regulators, or others alleging harm from management decisions, breach of fiduciary duty, misleading disclosures, wrongful termination, mismanagement. D&O covers defense and damages for these wrongful acts in their official roles. Physical injuries are CGL. Theft is crime/fidelity. Property damage is property policy. D&O focuses on management liability for corporate governance failures. Next question. What is the key difference between first-party and third-party insurance? Is it A, first-party insurance covers the policyholder's own losses, third-party covers the policyholder's liability to others? Or B, first-party insurance is for primary coverage, third-party is for excess? C, first-party insurance involves three parties, third party involves two? Or D, they are interchangeable terms? The answer is A. Insurance is divided by who receives the benefit. First-party coverage, e.g., collision, comprehensive, homeowner's dwelling/personal property, business income, pays the policyholder directly for their own losses or damage to their own property, regardless of fault. Third-party coverage, liability sections of auto, CGL, umbrella, pays others, third parties, when the insured is legally responsible for their injury or property damage. Primary versus excess is layering, not first/third. Party count is not the distinction. They are fundamentally different, own losses versus liability to others. Next question. What does jumbo risk refer to in insurance? Is it A, a risk with exceptionally high policy limits or loss potential? Or B, a risk involving elephants? C, a risk that is rejected by all insurers? Or D, a risk in the surplus lines market only? The answer is A. Jumbo risk describes an exposure with very large insurance limits or catastrophic loss potential, e.g., high-value buildings, major liability for large companies, mega yachts. These often require multiple insurers, reinsurance, or specialty placement due to capacity limits. Not animal-related. Not automatically rejected, though may go surplus. Not exclusively surplus. Jumbo means unusually large-scale or high-limit risks. Next question. What does pro rata cancellation mean? Is it A, the insurer returns the unearned premium proportionally to the insured? Or B, the policy is canceled immediately with no refund? C, the insured pays a prorated penalty? Or D, the cancellation is divided between insurer and insured? The answer is A. When a policy is canceled midterm, by insurer or insured, pro rata cancellation calculates the refund based on the exact unused time, e.g., if 6 months remain on a 12-month policy, roughly 50% of the paid premium is returned, subject to any minimum earned premium. This is a fair, time-based return of unearned premium. No refund or penalty applies in short-rate cancellations, often when insured cancels. Not divided responsibility. Pro rata ensures equitable refund for remaining coverage period. Next question. What is residual market in property and casualty insurance? Is it A, mechanisms like assigned risk plans or fair plans that provide coverage for risks unable to obtain it in the voluntary market? Or B, the market for selling used insurance policies? C, the market for residual coverage after a loss? Or D, a secondary stock market for insurers? The answer is A. The voluntary market consists of insurers who freely choose which risks to accept. When high-risk applicants, poor driving records, high-crime areas, dilapidated buildings cannot find coverage from standard carriers, residual market mechanisms step in, assigned risk plans, auto, fair plans, property in high-risk areas, or state pools to ensure basic availability. Insurers share these risks proportionally. Not used policies, post-loss coverage, or stock market. Residual market is the insurer of last resort system for otherwise uninsurable risks. Next question. What is the purpose of a loss cost filing by a rating bureau? Is it A, to provide insurers with projected loss data, to which they add their own expenses and profit to determine a final rate? Or B, to set the final, non-negotiable premium for all insurers? C, to determine the cost of losses after a disaster? Or D, to file the cost of lost policies? The answer is A. Rating bureaus, like ISO, collect industry loss experience and develop loss costs, pure premium estimates for expected losses and loss adjustment expenses per unit of exposure for different risk classes. These loss costs are filed for advisory use. Individual insurers then add their own loading for expenses, commissions, overhead, profit, and contingencies to arrive at their final rate. This modular approach allows competition while sharing reliable loss data. Loss costs are not final premiums. They are prospective, not post-disaster. Not for lost policies. Loss cost filings promote consistent, data-driven pricing with room for insurer variation. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.